Mastering investing from zero. Turn small money into long-term wealth. In the next few minutes, you'll learn the real difference between saving and investing, how compound interest quietly builds wealth, how the stock market actually works, and the simple strategy beginners use to grow money without needing a fortune. Welcome to our channel, where we discuss finance and financial strategies designed to help you build strong financial foundations, stabilize your current finances, and support long-term financial growth toward financial freedom. Today, we're exploring the core ideas from The Intelligent Investor by Benjamin Graham, focused on helping beginners understand how to start investing from zero. Now, take a moment and reset your mindset. Forget the idea that investing is gambling or only for rich people. If you've ever wondered how small amounts turn into large fortunes, you're exactly where you need to be. Most people earn money by working. They exchange time, energy, and skills for income. This is called active income. Active income stops when you stop working. Investing flips this idea completely. Instead of working for money, your money starts working for you. Wealth begins the moment your money starts earning on your behalf. If you stop working, your paycheck stops, but investments can keep generating value even while you sleep. That is the goal. Now, here's a common beginner mistake. People confuse saving with investing. Saving means keeping money safe, usually in a bank account. It's useful for emergencies and short-term needs. Saving protects your money, but it does not grow it. But there's a hidden problem, something called inflation. Inflation means prices rise over time. If you keep $100 in a bank, it may still be $100 next year, but that $100 will buy less than before. Inflation silently reduces the value of your money every year. So to build wealth, your money must grow faster than inflation. That is why investing is necessary. Money must grow, or it slowly disappears in value. Now, let's address fear. Investing involves risk. Prices go up and down. But here's the key idea. Risk is not fixed. It can be controlled. Risk is not a wall, it is a dial you can adjust. Higher returns usually come with higher risk, but smart investors manage risk over time. Now, let's understand how money grows. This is where compound interest comes in. Compound interest means earning returns not just on your original money, but also on previous returns. If you invest $1,000 and earn 10%, you make $100. Now you have $1,100. Next year, you earn 10% on $1,100. You don't just earn money, you earn on your earnings. At first, growth feels slow, but over time, it accelerates rapidly. Compound interest turns patience into powerful growth. Time is your biggest advantage. Starting early matters more than starting big. The best time to start was earlier. The second best time is now. Now the question is, where do you invest? Let's start with stocks. A stock means ownership in a company. If you buy a stock, you own a small part of that company. If it grows, your investment grows. Stocks give you ownership, and ownership creates opportunity. But stocks can go up and down. They're powerful but volatile. Now let's talk about bonds. Bonds are different. They're loans. When you buy a bond, you lend money to a company or government. They pay you interest and return your money later. Bonds are about stability, not speed. Stocks are like the gas pedal. They help you grow faster. Bonds are like brakes. They provide safety. A strong portfolio balances growth and protection. Now, beginners often worry about picking the right stock. That's difficult. This is where diversification comes in. It simply means spreading your money across many investments. Never put all your money in one place. Instead of buying one company, you invest in many. But buying hundreds of stocks individually is hard, so we use index funds or ETFs. An index fund is a collection of many companies in one investment. When you invest in one index fund, you're investing in an entire market. One investment can give you access to hundreds of companies. Historically, markets rise over long periods despite short-term crashes. Markets fall temporarily but grow consistently over time. Now let's talk about strategy. Many people try to time the market. They try to buy low and sell high, but this is extremely difficult. Instead, use dollar-cost averaging. This means investing a fixed amount regularly, regardless of price. Consistency beats perfect timing. Sometimes prices are high, you buy less. Sometimes prices are low, you buy more. Over time, this balances your cost and removes emotional decisions. Automation removes fear from investing. Now, let's talk about psychology. Markets will fall. Your investment might drop in value. Your instinct may be to panic and sell, but if you sell during a drop, you lock in your losses. You don't lose until you sell. If you stay invested, markets historically recover. For long-term investors, dips are opportunities. A market drop is not a loss, it's a discount. Think long-term, focus on years, not days. Wealth is built by patience, not reactions. Now let's take action steps. First, check your finances. If you have high-interest debt, pay it off first. Debt interest grows against you. Investing works for you. Next, build an emergency fund. This protects you during unexpected situations. Emergency funds protect your investments from being disturbed. Then, open an investment account. Depending on your country, there are tax-advantaged options. These help your money grow faster. Reducing taxes increases your real returns. Now, choose your investment. For beginners, a low-cost index fund is a simple and powerful choice. Set up automatic monthly investments. Automation builds wealth quietly and consistently. Then, live your life. Don't check daily, don't react emotionally. The best investors are often the most patient. Investing is not about getting rich quickly. It's about building wealth slowly and reliably. Slow investing creates lasting freedom. Every dollar you invest is working for your future. Your money is your employee. Put it to work. Now let's quickly recap. Saving protects money, but investing grows it. Inflation reduces value. Growth protects it. Compound interest builds wealth over time. Stocks offer growth. Bonds offer stability. Diversification reduces risk. Index funds simplify investing. Consistency beats timing. Patience beats panic. If you understand these basics, you're already ahead of most people. If you found this helpful, make sure to like the video. It helps us reach more learners like you. Subscribe to the channel and turn on notifications so you never miss valuable financial lessons. Share this with someone who is afraid to start investing. Let's build financial freedom together. See you in the next video.